Good afternoon, everyone, and thank you for joining us today for Morphic Ethical Equities Fund webinar. My name is Anton Yasnev, and I'll be guiding you through the session today. Today, I'm joined by the non-executive chairman of MEC, Jack Lowenstein, and a portfolio manager, Nick Markiewicz. As part of this session, we will provide you an update on the fund, the investment team, and the process, touch on how we're positioned, and share some thoughts on the current market environment. We've also set some time for your questions, so feel free to submit those questions via a Q&A box at any point during this webinar. I will now pass it on to Jack to make some opening comments before diving into the portfolio discussion with Nick.
Good day, everybody. We didn't know when we scheduled this meeting, but I'm very happy to say that we'll be reporting we've had one of our best years at the fund since its launch eight and a half years ago. I really wanted to have this meeting to introduce Nick, who has took over as PM in January, having joined the team in the middle of last year. But I should also note thanks to Bill, who was formerly the manager and who remains a consultant with the fund. I'll talk about performance in more detail later, but I'm happy to say that the year ended, and I must stress these are unaudited figures that will be subject to some year-end adjustments, but we ended with a gross performance for the year to June 30th, 22.9%. Net of all fees, but after adding back some of the gains we got from the buyback, we had a portfolio experience of about 21%. Against our benchmark of 18.4, so our alpha net for the year was 2.6%, which is a pretty good outcome given the expense of the fund, etc., etc. I just want to touch on one other issue before I hand over to Nick. We've had a lot of questions about dividends. We did not pay a dividend during the financial year, and the reason for that was that during the previous financial year we exhausted all our franking credits. And I've had a lot of feedback from many of our investors saying, please don't pay dividends if you can't frank them. So our capital management activities over the year have been really focused on share buybacks. During the calendar year, we bought back 5.1 million shares for a total cost of 5.275 million, an average price of a little under $1.03. What that meant was that we actually made a profit from the buyback of about $750,000, which was an appreciable contributor to the performance and helped absorb some of the fee and expenses costs. So we do want to pay more dividends. It will depend on us generating franking credits, and the franking credits in turn will depend on us generating taxable income. We have quite a large unrealized tax gain, which is why the gap between the reported pre- and post-tax NTA is widening. At some point, that will close, and that will be the moment when we hopefully start paying some dividends again. And on that note, I'm going to hand over to Nick.
Thanks, Jack. Thanks, Anton. So thanks, everyone, for joining. I'm just going to, over the next 15 or 20 minutes, run through, I suppose, the strategy, the team, recent performance, how we're seeing markets, and then maybe a stock or two that we're looking at, and I guess how we're expressing our views in the markets. Jack mentioned that I've just taken over the portfolio manager role. I joined Elliston a year ago. I took the seat 6 months ago, but outside of that, the team actually has not changed. So the team's up on the screen there. Bill, who was the portfolio manager, is still very much part of the team and still sitting alongside all the other analysts as well. So we've now got a 5-person team and what I consider to be a really, really good bench and some really good ideas coming out of the team. So a good starting point. Just to remind those on the call, and this is probably going over old ground for many of you, but there are a few guideposts, as we call them, that define what we do with the strategy in the portfolio. And that is we're a concentrated fund. We hold between 20 and 60 stocks. There's currently 37 in the portfolio today. Very simply, the reason we're concentrated is we believe our first 5 or 10 ideas are better than our last 5 or 10. And when you have a small team, it's generally better focusing your time and effort on your highest conviction ideas rather than building a book of 100 ideas that are smaller and you have less conviction. We have a small mid-cap bias. I'm going to talk about that a little bit later on, why we do that. But for all intents and purposes, our constraints are we tend to look for stocks below $30 billion US. That's a large stock in Australia, but by global standards, that's still relatively small. We are focused on absolute returns, and we have a contrarian bias to our investing style. And contrarian doesn't necessarily mean finding stocks that are hated by the market. It means, in our view, finding stocks that have been mispriced by the market. And there's lots of reasons why stocks become mispriced, which I might talk to later on. And then finally, there are some ethical considerations we make in our investments in terms of exclusions, specific exclusions, but also stocks that we try and target as well. Just to give you some context, so we have a $30 billion ceiling in terms of the market cap we focus on, but the portfolio has small and mid in its name, which tends to sometimes put some people off. But to give you some context, the stocks that we are buying are large by Australian standards. These are big companies that would sit amongst some of the biggest companies in Australia. So they're not minnows overseas. They're actually quite large, established businesses. They're just not some of the big mega caps that dominate most portfolios. So we have a SMID bias, and the reason for that is quite simple. We think mid-cap stocks tend to sit in what we call the sweet spot of the global equity universe, and that is stocks that are reasonably well established. They've got access to capital markets. They've generally got, they're businesses that have been running for 10, 20, 30, 50 years. But by being smaller, they also have a higher capacity to grow. When you invest in large companies, trees don't grow to the sky. And so we're trying to find businesses that offer the best mix of growth, but also stability and balance sheet funding and things like that. I mentioned the screens before, but they're all pretty straightforward and as per the PDS, but we tend to avoid all the things in red. And where possible, we try and find good quality investments in the areas in green. And I can talk to more of those later, but we have found a lot of good investments, particularly on the renewable energy side and the energy efficiency side. So in terms of the investment outlook, it's been obviously a very volatile last 6 months. But one thing I would note is that global small and mid caps, as a universe or a sector, if you want to call them that, they have suffered their largest underperformance relative to large caps. And I think that's actually the largest performance in their history going back 25 or 30 years. Now, that is a really interesting phenomenon, and it's interesting for two reasons. One is that, the main reason is that small and mid caps have actually, over their history, tended to outperform large caps. And for the reasons I mentioned before, they're smaller, they've got more room to grow, and they can outperform larger stocks that have that natural ceiling. So to have underperformance like this, that you can see on the right-hand side of the screen, is quite remarkable actually over their history. And I think there's two reasons for that, two primary reasons. One is that since around 2017, you've had the dominance of what we call the Magnificent Seven, which is the mega cap tech. The Mag 7, which have all performed unbelievably well, have accounted for the vast majority of the S&P 500's growth, so just 7 stocks. The other factor that you've had as well is higher interest rates, particularly since the tail end of COVID. And higher interest rates aren't necessarily a good thing for smaller companies, given they all tend to be traded lower when interest rates are high. So we're now at a point where small, mid-sized companies have had a record underperformance. And we're at a point now where I think we're starting to see a lot of value emerge over different sectors, different geographies, but also a lot of different investment themes as well. And I can touch on those later. But Some of the themes that we're seeing in the market today that we find really interesting are AI, so artificial intelligence, in the payment space, electrification, aerospace, and then some of the industrials in the EU that are seeing a tailwind for the first time in many, many years. So, all I would say is that typically speaking, we're contrarian investors by nature. And when we see a whole sub-asset class trading at a massive discount and massively underperform a part of the market they've typically outperformed, that's an interesting starting point for us. And the final thing I would say is that the market has been, as you all know, incredibly volatile, and volatility tends to create a lot of opportunities. The tough thing about volatility is it's hard to foresee where those opportunities are and when they will come, but volatility typically creates opportunities, which I think we've done a reasonable job of capturing over the last couple of months.
Thanks very much. So I think I've covered most of it already, but the figures you can see on the screen are the figures to the 31st of May, which are signed off by the finance team here. The figures I gave you previously, which I'll reiterate now, are that the gross performance, which is the line you see in the bars, was for the financial year was 22.9%, as against the benchmark at 18.4%. Obviously, what that tells you, we had a very good June, and I'm very happy about that. Clearly, looking at the longest term, this has been a bit of a disappointment, this fund, but I think we really think we're on a good track now to claw back some of those previous underperformance. I'm particularly pleased, I would say, to see the fund concentrate a bit more, which I think is going to be a big driver of performance.
So I'm just going to spend a minute or two just talking about how we position the fund and some of the fund's characteristics or the portfolio's characteristics. But, as I said at the start, we have a contrarian bias to what we do. Contrarian to us doesn't mean buying the dogs of the Dow and buying, companies that are severely beaten up and hoping for a reversion. For us, it is buying what we call mispriced businesses. And we think mispricings typically occur in two fashions. One is that maybe the market overreacts on a short-term basis to a news event and typically sells down a company and I guess bakes in a lot of bad news into a company's stock price when maybe the reality for that company hasn't changed too much. And then the other way mispricings occur is when you get a nice growth theme that the market simply doesn't appreciate and is not on top of, and consensus forecasts for that company are perhaps a little bit too low. And the reason we think, particularly in small caps, and this is again why we prefer to look in small and mid-sized companies, is that the companies that we look at are not that closely followed by the market. They tend to have far fewer analysts covering them. The company's management teams are far more accessible. And so we think the mispricings in small mid-caps occur more frequently. And for us as analysts and investors, we think we have more opportunity to take advantage of those by doing some fundamental work on some of the names. So the four buckets, and I would sort of stress that these are loose buckets. Not every stock fits nicely into a matrix like this. But generally speaking, the four buckets that we are finding stocks in and we're trying to invest in sit in the four on the screen there. So we like to find secular growers, that is the good quality businesses that we think are mispriced. We like to find opportunistic investments, so maybe special situations like spin-outs, relistings, recapitalizations, things like that. They typically tend to be a small part of the portfolio. They come along sporadically, but when they do, they can be very profitable. We like to find quality defensives, businesses where we've got a direct line of sight to their underlying asset value, and we've got a catalyst for why the stock might be higher in the future. And then finally, and not least, because it's the biggest part of the portfolio, but we love to find, what we call mispriced compounders. That is, businesses where, we think these are high quality franchises. They're franchises that have a lot of duration, but the market, for whatever reason, has discounted the stocks. So for example, Corpay, which is in the top left bucket, it's the largest stock in the portfolio as of a few days ago when I last looked. I'm not sure what it is on the screen, on the next screen, still is. Corpay is one of the best companies I think I've ever found in my career. It's got a 20-year track record of compounding EPS at high teens. So that puts it in an elite club of only, I think, 15 businesses over history that have managed to do that. It's still owned by the founder. It has a 55% EBITDA margin, and this year it's expected to grow EPS by 20%. So the market doesn't like this business for a bunch of reasons, but the most recent being all this noise around stable coins and what that means for payment systems, and whether Visa, MasterCard and Corpay will have a future in that. But if you look at the long-term history of this business, it's grown EPS at that high teen rate, as I mentioned, and it's grown through recessions, it's grown through all kinds of volatility events, news events, and we've got an opportunity to buy that at a very, very modest valuation in today's market. So that's an example of the type of business that we're trying to buy. But if I look at the the general, what I would call the general characteristics of the book today, I've got the top positions on the left-hand side there, and I'll go through one of them on the next slide in a bit more detail. But look, the portfolio today, we are paying effectively the same valuation as the market, so that 21, 22 times earnings. However, what I would draw you to is two things on the right. One is the high ROE that we're getting for our book, so 17%, which is not dissimilar to the MSCI large cap index. However, as I said before, we like businesses that grow, and the two things I'd point to on that table on the right would be the revenue growth we're getting at 10% and the EPS growth at 19%. And a big part of that is we find businesses that are sometimes pre-earnings, on a very rare occasion pre-revenue, and there's a lot of embedded growth in some of the portfolio holdings. So if I was to summarize, I'd say you're paying market for a portfolio that we think can grow significantly above market by a multiple factor. And maybe just to sort of round it out, I've got a case study here of a business that we absolutely love. It's called AerCap. So AerCap is the world's largest owner and lessor of aircraft. So they own 2,500 commercial aircraft, and they lease those out to airlines around the world. It's effectively a flying bank, as I sort of like to characterize it. There's a lot of traits to this business that we really like. One is that they have consistently grown book value over a number of years. We're talking decades, not just 5 or so years. It's run by a high-quality management team that the CEO owns roughly 4 or 5% of the company. But we like this business particularly because we think aerospace is a really attractive place to be. So why is that? There's two factors that are really driving things. One is that through COVID, because supply chains were effectively shut or impaired for 3 or 4 years, there's been a significant underbuild of aircraft by Airbus and Boeing. And we're seeing that now in the backlog of aircraft grow to over 10 years, which is the highest backlog these OEMs have ever had. And what that's doing is putting pressure on leasing rates, upward pressure, I should say, and on residual value for aircraft. So aircraft are becoming more expensive. The second factor, and the reason we like the space is, if you look over a 60-year history of leisure travel, as defined by passenger kilometres, has basically grown at twice GDP over 60 years. There's not many industries in the world that can do that. And air travel has consistently done that over many, many decades. And it makes perfect sense in people are getting wealthier across the world. And one of the things you like to do as you get more money is take more holidays and travel more. So we think we've got a really interesting setup for an industry and a business where capacity has been significantly constrained, and at the same time, demand has actually accelerated since COVID. And as I mentioned before, what that's transpiring to for AerCap is higher lease rates on their aircraft, which means more revenue for AerCap, but also higher residual values for aircraft on book. Why we bought this business, and when we first bought it, we were attracted to it because the business was actually trading below book. So we were buying it at roughly a 10% discount to book value, which we thought was quite odd considering the factors that I mentioned above. And we got confidence to buy it because one key reason was that we had good visibility into residual aircraft values. So aircraft on book were being sold at a 50 to 80% premium to their accounting value or their book value. And I guess what gave us even more confidence was the stewardship of the management team. So the CEO, as I mentioned, is probably one of the best capital managers I think I've ever seen in my career. They have a really good handle on how they spend shareholder money, whether it's on new aircraft or whether it's buying back stock. And management went through a period of 3 years where the company was trading at a discount to book value, but they were selling aircraft at a massive premium to book value. And what they were simply doing was selling an aircraft and walking to their treasury team down the hall and buying back stock that day. So what you've seen actually is huge accretion in book value per share. And I would say that chart on the left actually undersells it a bit because through COVID, through 21 and 22, they actually had aircraft in Russia, which they had to write down. So you actually, were it not for that, you would have seen an accretion in book value through those years as well. Not bad for a business that had effectively their end market shut down for 2 years. And what we've seen since actually is they've had insurance settlement wins in the last actually 3 months where they've basically insurers have paid out the written down book value over 2021 and 2022. So looking forward, we think this business is going to compound book value really, really nicely. We think it deserves to trade at a premium to book. It still trades at roughly it's at about a 5% premium to book today, but I think it probably deserves to trade at a 20 to 30% premium to book. And that book value is going to compound at a very steady rate. So when we look at the markets today, there is a lot of uncertainty. And, I think over the last 6 months since taking the role, we've had a collapse in AI stocks at one point. We've had tariffs. We've had war between US, Israel and Iran. And we've had a fall in the US dollar. So you've had a whole bunch of things happen. And so what we're really trying to do is just find really, really nice businesses where we can see a structural reason why value is going to accrue in those businesses. And we're trying to back management teams that we think are within that setup going to accrue value for us as shareholders. And we think we found one with AerCap. And we hope that it's going to be a core part of the portfolio going forward. So I've given an overview of the process for AerCap or the setup for AerCap. But the other thing I'd say is there are 37 stocks in the portfolio, and we've got equal excitement about the rest. And we think the rest are well placed to grow as well in, again, as I said, a pretty uncertain outlook. So that's sort of the end of the prepared remarks. Anton, I don't know if you want to
No.
close off or...
Well, we've received a number of questions through this session, and I think it's probably worthwhile spending the next 5 to 10 minutes just addressing some of these questions. There's a number of them. We may not get through every single question, but rest assured, if we don't cover that as part of this session, we'll come back to you directly and address those questions. Nick, first one's for you. Can you talk us through any recent portfolio changes and your thinking behind them?
Yeah, so as I just mentioned before, over the last 6 months, we've seen a lot of volatility. We saw a pretty significant drawdown in March and April alongside all the tariff news. And I suppose the biggest change over the last 6 months has been adding new stocks into the portfolio through that period. And so it was a pretty challenging time. And so what we were focusing on was, again, these either quality defensives or mispriced compounders that we thought, regardless of whether the US went into recession or not, and regardless of whether tariffs stayed or they were, lowered or withdrawn, we think we could make money. So we added to new positions in highly defensive but good growth businesses, particularly in the US waste space. We bought a business called Clean Harbour, which has 80% of the incineration capacity in the US. So very defensive business. Volumes for incineration don't really move much. At all, regardless of what GDP is doing. And they've got enormous pricing power given their near monopoly position. We also bought a business called TradeWeb, which again is a very defensive business and acts as a settlement function for bond trading. And that's actually more a proxy for volatility in the market. So that's actually been a nice investment too. So, those are two. We added some more, but we've been adding businesses that we, again, think are really nice businesses that we can buy at a good price. And we've been selling businesses that either don't necessarily meet the quality that we can find elsewhere in the market at a given time. So we've used the volatility in a positive way over the last few months to add to the portfolio.
Well, the next question actually expands a little bit more on that answer. What impact has the market conditions had on the fund positioning from country perspective? Are you looking to rotate out of US stocks more into Europe as opportunities arise, or do you look across the board?
Yeah, that's a good question, and a nice question given we've had the biggest first 6-month fall in the US dollar, I think, since 1985 or something like that. Look, the portfolio today is still predominantly in the US. I think it's around 65-70% of the portfolio has been in the US. Actually, I would say almost ironically, we've been adding to a lot of our US stocks. At the time in March, April, there was a lot of calls for the end of the US and end of US exceptionalism, I should say, and everyone was banging the drum on Europe. But at the same time, there was a lot of opportunity in the US, particularly in the AI side of things. So the US is still a big part of the portfolio, but we've been adding selectively, I would say, in Europe as well, particularly companies that we think are going to do quite well from EU stimulus, which appears to be the first big EU stimulus program in a long, long time. So look, I would say the portfolio today is still very balanced across geographies and with a skew towards the US. And I'm kind of happy with that given, I think the one lesson from the last 6 months is, a lot of strange things can happen in markets, and it's hard to say, what they're going to be and how the markets are going to react. So, I'm happy with the diversity of the portfolio and the positioning that we've got.
Thanks, Nick. The next one is a two-part question, and I guess it again expands more on a view on a portfolio, but from a forward-looking perspective. So, how's the team viewing the outlook for the global equities? And then second part to the question, and we could probably treat it as a separate question, is how often are you meeting companies face-to-face, or do you do it all remotely?
So first question, outlook for equities. I mean, I think I addressed most of that on that slide before, which looked at the underperformance of small mid caps versus large caps. But, I think there's, at a high level, I would say market valuations are, they're certainly not cheap. They're certainly not that expensive, but certainly not cheap. And at a more granular level, we're now sort of starting to see earnings estimates get cut a little bit. So, I wouldn't say it's put a spinnaker up and sort of running sort of headfirst into fully invested. But, I would say there's plenty of opportunities out there in different pockets. I think I was chatting to someone this morning. He asked me what's the next big thing after AI. And, I would say, and to give an example of, I guess, how we're looking for opportunities and where we're looking, I mean, if you look at any interest rate sensitive business in the US, they've all been hit obviously very hard given what inflation's done and where rates are. We're now starting to see yields fall a little bit. So interest rates coming off. And, I think there's good value in a lot of these sectors, whether it's home builders. So some US home builders are trading at GFC style valuations, despite being very profitable and having very different balance sheets to where they were, building products, also trading at very cheap multiples given the consolidation that's happened in those spaces, the profitability of those businesses. So look, we haven't made any investments like that yet, but it gives a sense of sort of, I guess, how we're viewing the market and where we're looking to invest. But generally speaking, we just like to find, as I said, businesses that we think are mispriced, and we're looking all over the world, lots of different markets. Sometimes those opportunities come up individually, but sometimes you can sort of have a thematic or sector-wide view, whether it be US builders or AI, as is the case now. And the question on meeting companies.
How often and how do you do it? Is it based on?
Yeah, so we chat to companies almost daily. The bulk of our conversations, just given where we sit, are via Zoom. And given our time zone, are either very early or reasonably late in the evening. But the access to companies is great. And I would say, as I mentioned in the comment before, covering small and mid-sized companies actually means you get more access to management than if you covered large cap companies. And even if you were sitting in the US. So I 2 jobs prior used to cover lots of large cap companies, and if you wanted to chat to them, it's basically take a ticket, wait in line, and you get given your half an hour every 3 months, 4 months if you're lucky. Whereas small companies, management are far more generous with their time. You often get to speak to the CEO, and you can speak to them often as much as you want. So, we get good company access, and part of our job is traveling offshore. So I was in the US in late February, early March. And I did a 2.5-week trip then, seeing companies at a few conferences as well. So, I aim to do 2 to 3 trips a year, but the bulk of our communications on calls and over Zoom, which works really well, particularly given the access that we get with companies.
Thank you, Nick. I think we have addressed all the questions that were given to us, and we are right on time. So on behalf of the team, I thank you very much for your time for joining. If you do have any further questions, please get in touch with us directly. Otherwise, we look forward to speaking with you soon.